Question 3 brought about our first analysis question. So these are always very, very difficult questions on analysis. And what we were given was stock turnover and creditors turnover. And one thing that was important was we were given the actual result for this year. But this figure here was actually a budget, so it hasn't actually happened. So when we talk about that, we don't want to talk about what did or didn't happen. We're going to talk about what's expected to happen because these are predicted events. So the first question was, the owner thinks that if they improve stock turnover, that should increase gross profit. Do you agree? And explain. So what do they mean? Well, they're anticipating that stock turnover will go from 90 days to 80 days. And when you take it into a sort of context, it's talking about will gross profit go up? Well, I guess what you want to think about is how could stock turnover get better? So to do that, you really need to remember how it's calculated. So if we do stock turnover in days, it's the average stock by 365 divided by the cost of goods sold. So this is where you need to remember the actual how it's calculated, but you won't get any marks for doing so. And what's important to remember now is that, well, how can you make this go down, as in decrease in days? So mathematically, there's only two ways. The first way is you can either make the number on the top go down and keep the number on the bottom the same, or the other way is you can keep the number on the top the same and make the number on the bottom go up. Either of those two approaches would improve stock turnover, and that's the prediction. They're predicting it will go down, and that's the only two ways to do it. So I think the best way to answer this question is well, let's look at option 1. We make average stock go down and keep cost of goods the same. Would that increase gross profit necessarily? And this is where it doesn't say discuss. That's probably a bit misleading. We can actually have an argument either way. So on the one hand, that is probably true. If I do manage to make my average stock go down, so I'm going to decrease that, okay, will that make my gross profit go up? Well, one argument would say yes. If I sell the exact same amount of goods, so that would explain the ratio getting better, as long as I increase the markup. So if I increase the markup on each sale but sell the same amount, I'm going to have a better gross profit. However, when we look at option 1, we said we can decrease stock and keep cost of goods sold the same. Will that increase gross profit? Well, another argument could be that's wrong. If I decrease the amount of stock on hand, so I manage to do this, okay, it could be a problem for gross profit if I only sell the same amount of goods, which I said mathematically would need to happen. But what if I can't I sell the exact same number of goods as last year, but the markup on each one has gone down or actually stays the same? Now, if that happens, gross profit won't actually go up. So that's an argument against the owner's statement. Looking again at option 1, we said decrease average stock, keep cost of goods sold the same. Will that increase gross profit? Let's have another argument against. If I decrease the average stock on hand, that actually might not lead to an increase in gross profit if this figure here actually went down and we sold the same amount. But what if average stock went down because there were stock write-downs and stock losses? Well, that will actually decrease my gross profit. It comes out at adjusted gross profit, but it's still gross profit. That will decrease if I sell the exact same number of goods as last year, keep average stock lower. Well, if I've got more stock write-downs and stock losses, I'm actually going to have a lower gross profit. So the owner's argument is incorrect. Lastly, for option 1, that's the way we can achieve it. I'm going to argue that if I manage to decrease average stock, okay, will that increase gross profit? Well, one argument could be no. What if stock levels decrease, but actually cost of goods sold decreases more? So we've got a fatter arrow here to say that this has gone down more than this. Now, mathematically, if that happened, your stock turnover in days would get better. It'd decrease. But what that could mean is gross profit's gone down because your cost of goods sold has decreased by more than your average stock. That could be because we've discounted stuff. Now, if we discount with lower markups, that's not going to increase gross profit. Or maybe we even lose customers. We're holding so little stock that customers can't find what they want, so they don't buy from us anymore and they go to a competitor. So there's 4 arguments. We only needed 3 for this question. But let's have a look at some more. So another thing is, how can we make stock turnover get better? The second way was, we keep average stock the same, but we manage to sell more goods. So if we do that, will that increase gross profit? Well, one argument is yes. If I keep obviously stock the same, but if I sell more goods, all I need to do then is keep cost of goods sold, or sorry, the markup the same, or in fact increase it. But even if I keep it the same, I will end up with a better gross profit. Looking at that second option again, if I keep the amount of stock the same but increase cost of goods sold, will that necessarily increase gross profit? Well, an argument against that is, just because I managed to do more of this, will I get a better gross profit? Not necessarily if. I'm actually going to increase stock levels more. So if I increase stock levels more, what that means is I have more stock on hand, there's more chance of stock write-downs, there's more chance of taking longer to sell, that's going to decrease stock turnover, but there's more costs associated with buying stock if I've got more of it, so that could actually decrease my gross profit. Looking at that was a tough question, so I went through 6 points you could have spoken about there. You only needed 3, and obviously with an average of 1.1, a lot of the state had trouble with that. So 36% got 0, and then looking at the top end, again a tough question, only 9% of the state could get 3 out of 3. Looking at the examiner's comments, a lot of it came down to people misunderstanding something. Well, it asked about, could gross profit go up? It didn't say would gross profit margin. So that's the difference between profit and profitability, which is something you need to revise when you do your analysis revision, the difference between a number and a ratio. Secondly, just because if a business, it's like the most logical thing is, if a business increases stock turnover, that means you're selling more goods. And usually that means, unless I'm selling at a lower markup, I'm probably going to have a higher gross profit. So that was probably the obvious point to make. However, some students indicated that if I've increased stock turnover or made it faster, that might mean fewer sales, but there's no sort of logical or mathematical basis for that. So all in all, a very tough question.